Well, investors may want to temper their enthusiasm over potential rate cuts. Chicago Fed President Austin Goolsbee telling Squawk Box this morning he's confused by the post-Fed decision market rally. Goolsbee believes the market may have misunderstood the Fed's intended message about cutting in 2024.
The market expectation of the number of rate cuts is greater than what the SEP projection is. So whether that's priced in or not priced in, that is a difference.
Joining us with some reaction, Torsten Slok, Chief Economist at Apollo Global Management. Torsten, great to have you with us. It's not just Goolsbee walking. I mean, every single Fed official who has come out since the Fed meeting last week has tried to backpedal, and the markets just do not want to listen. What do you think is going on here?
Well, I think that they are quite worried that financial conditions, if they ease too much, it may complicate their job of getting inflation back to 2%. Remember last week we got core CPI, which is now at 4%, 4.0, and their goal is to get it down to 2. 4 is not 2, so we still have quite a road to go here before we get down there. And I think they are telling us that let's just take a little break here and figure out, well, if this is going to take a longer time, then it will certainly come with more Fed hawkishness than what the market is interpreting from what he said last week.
Do you think that do you think the markets are mistaken, or do you think the Fed made an error in letting the markets think that? Because it did seem that everybody walked away with that conclusion that a pivot is underway and that there will be cuts next year.
I do think that when you look at the dual mandate of inflation has to get to 2% and we have to be at full employment, an honest assessment is that they were right in the sense that we have to recognize that inflation has come down faster. So on the back of that, I do think that they just said, well, the data is better than we expected. And on the back of that, I think that they were surprised that markets interpreted that as dovish as markets have done. So I think it's both them having no other choice than to recognize that things are getting better, but also at the same time the market over-interpreting what he was saying. Because I think that the fact all these FOMC members afterwards coming out and saying, no, this was the wrong interpretation, I think that should make us all investors see, hey, hold on, maybe this was not the right interpretation.
Are you concerned that the negative impact on the economy is now greater? In other words, that the soft landing scenario is actually more jeopardized because of what the Fed has done and because of the resurgence and risk assets that will be underway because of this pivot, as opposed to if we just left rates higher for longer and stuck by that and waited?
Well, I think that the easing in financial conditions could almost switch us back to no landing, because now we will probably have still a strong housing market. You saw the home builder sentiment today rebound. Next employment report could be decent. You could also begin to see consumer spending be decent. All that could suggest that the economy is now getting a lift, which is, again, complicating their mission to get inflation back from 4% down to 2%.
So, Torsten, the last time the 10-year yield was at 3.9%, which is essentially where it is right now, was kind of early August or so. The S&P 500 has rallied 10% since then. So talk to us a little bit about that disconnect, because the move from 4 to 5 and back down here was pretty quick, right? And it really didn't get embedded into the economy so much. So what is, like, if you're buying stocks here at 52-week highs, very near all-time highs, where do you expect the 10-year yield to be to continue that rally in equities?
Yeah, I think an important starting point for that is exactly, well, where did we come from and where are we going? And we came from a point where supply chains were getting straightened out after COVID. That has been the low-hanging fruit for inflation to come down from 5 or 6 in core inflation to now around 4. But the last mile is indeed going to be a lot harder, because now we're actually beginning to see supply chain risk appearing again. So that might mean that, well, the easy part of getting down with inflation was really all what was behind us. But ahead of us is now, not only do we have the Red Sea flare-up and everything that's potentially putting upward pressure on inflation, but we also have easing financial conditions that could also complicate this job of getting inflation from 4 down to 2. So that's why I think that the pendulum now has swung too much in the dovish direction, and now Fed readings will basically have to go back, and the Fed communication will have to go back, exactly as we're seeing today also, to be more hawkish.
I agree. I mean, but do you think there's any wiggle room around 2%? Like, could they change the number or change the target? Because it's kind of arbitrary, and 2% is actually pretty low relative to history.
That's true. I think Loretta Mester has said it very well. We may change the target, but only once we're back at 2. So they have
know until we get there.
Yeah, I know. Don't change the goalposts and move them around in the middle of the game. So I think that they're saying to maintain our credibility. We've been told by Congress that this should be 2%, meaning getting inflation back to 2% is our goal. We have to get it back to 2, then we can have that conversation. So I do think that at this point, literally all FOMC members, without exception, have said we got to get down to 2 to make sure that markets, in particular in rates, don't come out with the expectation that the inflation target is going to change. Because think about it, if they tomorrow came out and said, we're now changing the inflation target to, say, 4%, what would long rates do? They might jump exactly with 200 basis points because now people want to say, well, I want to be compensated for the risk that the erosion of my bond portfolio is no longer 2%, but is now 4%. Right. So I think that changing the target and moving the goalpost in the middle of the game, I think they are signaling very clearly that's just not going to happen.
But